I would now like to go over exercise 8-4, and it's actually recording journal entries using the perpetual and periodic inventory system, and they actually give us information to prepare the proper journal entries. The first we're going to review is the perpetual system, and the perpetual system actually gives us the balance of inventory and accounts receivable at any time. So under a perpetual system, you would debit inventory for $155,000 for purchases and credit accounts payable for $155,000. Freight in would increase the inventory account, so you would debit inventory for $10,000 and credit cash for $10,000. Returns, you would reduce your accounts payable by $12,000 with a debit and credit inventory for $12,000. And for the sale, you would record the accounts receivable and sales, debiting accounts receivable for total sales on account for $250,000 and credit sales revenue for $250,000. And you would also record the cost of goods sold. Part of the perpetual system gives us the balance of both inventory and cost of goods sold at any time. Now, of course, that would have to be reconciled at the end of the year for the physical count of inventory, but you would debit cost of goods sold for $148,000 and credit inventory for $148,000. There is no end of the period adjustment. Now, for the periodic system, when we have a periodic system, we have a few new accounts. The purchase account is found in the income statement and is used to calculate the cost of goods sold. It is increased with a debit and decreased with a credit. In most instances, in this instance, using the periodic system, when you debit inventory under the perpetual system, you would debit the account purchases, which is an increase with a debit. Okay, now another account we will encounter is freight in. Freight in is again the freight in cost of $10,000. Freight in is increased with a debit and is also included in the cost of goods sold section in a periodic system. And we also have purchase returns. Purchase returns are increased with a credit and also used to calculate the cost of goods sold in the periodic system. So let us review this. So for the purchases of $150,000 under the periodic system, we would debit purchases for $155,000 and we would credit accounts payable for $150,000. For the freight, we would debit the account freight in for $10,000 and credit cash for $10,000. And for the goods that were returned, we would actually debit accounts payable because we don't owe the money anymore, which is $12,000, and we would credit the purchase returns. Now, just to repeat, purchase returns is increased with a credit and used to calculate the cost of goods sold. Now for the sale, we don't keep a running total of the cost of goods sold. So under the periodic system, we actually have to debit the accounts receivable and credit sales revenue for $250,000. Now, there is an end of the period journal entry. My suggestion to you will be to debit the ending inventory for $30,000 and credit the beginning inventory for $25,000. And then I would go and look at the purchase returns. purchase returns are a credit. Because we want to calculate the cost of goods sold, we would do the opposite. We would debit purchase returns for $12,000 in the end of period journal entry. And then we would go up to our purchase account, and it's a debit here of $155,000, but in calculating the cost of goods sold, we would credit purchases for $150,000. And we would also go up and see freight in is a debit, an increase in purchases, but we would have to credit to calculate the cost of goods sold, which is a credit to freight in for $10,000. So when we balance our debits and credits, we find that the cost of goods sold is $148,000, and we know that's correct because we kept track of it under the perpetual system, and that is important. That's the difference. Under the perpetual system, we know what the cost of goods sold is, but under the periodic, we have to do the journal entry and calculate the cost of goods sold. Now, we do the journal entry, and then after doing the journal entry, we then actually do the cost of goods sold section of the income statement. Beginning inventory is $25,000. The purchases were $155,000 less the returns of $12,000 plus freight in of $10,000. So our net purchases were $153,000. Our goods available for sale would be the net purchases plus the beginning inventory, which is $178,000, less the ending inventory of $30,000. So the cost of goods sold would be $148,000.